life from leaving school. So owned and run many companies, turned them around, sold them on. And what we're going to go through are just the basics of starting your own company, what to look out for, the pitfalls, the tax landscape, which is getting worse, especially for people in the high net worth environment where you're going to find yourself in a short while, I'm certain. So plan now is to just show you how to avoid the actual chaos. Okay. Can everyone see my screen just as a thumbs up and stuff like that? Perfect. Okay. I see there are some excellent. Thanks. Alrighty. So let's dive into it. So why do businesses implode? You know, I'm sure you guys have seen the stats. There's 9 out of 10 entities that fail within the first year. Of the 10% that survive after the first year, another 80% of them fail within the next 2 years. So effectively, after 3 years, you're looking at 2 or so entities that make it. Okay. And this is seen over and over again, all the countries around the world. So anyone have any ideas why they think businesses implode so fast after starting?
Maybe because they don't have a solid enough business plan, or if there's any kind of roadblock, they're not sure how to pivot from there, and then kind of don't know how to improve, and then things kind of die down.
Yes, that's actually that's a very much on the right track. And for the men in the audience, I'm going to say to you, it's almost indicative that it's a woman who's answered, because they're the ones who do the best at doing admin. So pay attention. This is crucial for yourselves. You need a solid base to get going. You need to look at all the fundamentals underlying your business, what is needed of you, keeping track of all of those items. And although you might not need to do the work yourself, it's a good idea to just have a very broad but sort of key understanding of the things that you need to be, so that when you do hire someone or you're leaning on someone to help you, you know to ask the right things. Okay. So it's essentially that. Create the foundations, set the checks in place so that you know the red flags will actually show as you're moving through your actual enterprise and things like that. So, okay. So generally you'll start at the beginning. And in your guys' field, being doctors, you're going to run into effectively 3 of these enterprises: a sole prop where you yourself are trading, personal liability company where essentially you can be held liable if your business, you can be held personally liable if your business does something that's sort of improper. And then obviously private companies, that's the standard basis. So if you're consulting and you're not actually doing doctoring per se, you would run a private company, or you can have both, or you can have all 3. Close corporations we put on the list because while they are still available, you can still utilize them. If you have one, you know someone who has one, you want to make use of them. So they are still available. They are still legal enterprises in SA, although you can't register a new one. Although ironically, they are more expensive to run nowadays than just a private company, because there's no need for audits, or yeah, no, private companies no longer need audits to a certain level, whereas closed corporations all need independent and reviews. So it does make it a bit more expensive to operate. So this will be the starting point where you guys are finding yourselves. You're either going to run ahead as a sole prop, or you're going to incorporate one of the two entities, an Inc. or a private company. Um, Regardless of which of the three entities you actually choose to start out with, you're going to still encounter the same regulatory framework like in SA. So what a lot of people seem to think is why one over the other, and these will be personal choices generally. And you'll find all the different bodies you register with. You could be a sole proprietor, you could be an incorporated, or you could be a private company. They'll allow each of these registrations, but it'll be a personal choice starting out, and it'd be a choice of growth, tax planning, things around that space. So it does help to think about this and then go talk to an expert with your thinking. Just like we'll come chat to you if we're not feeling well, it's good for you to go talk to somebody who knows what's taking place in the space. Because, yeah, as I said, the regulatory framework goes from there. So if you choose, depending on which enterprise you choose or which entity you choose, these are things you're going to encounter. Obviously, as a sole prop, there's no shareholders agreement, but you and another sole prop might have a partnership agreement, something along those lines, a joint venture agreement, which will sort of indicate how your sort of interactions are going to work. Okay. When you do register, you will have an MOR. That's a memorandum of incorporation. That's normally issued by the CRPC. That's a public-facing document. So anything along that space, anyone can get a copy of your MOR from CRPC. Things you might want to do is trademarks. You've got a clever, well, you've got a brand that you want to grow. Um, you can register your trademark. So to think about those type of things. This can also be trademarks, can be in your private name, can be in a CC, can be in a company. So just look at those type of entities, what they might be. And you might obviously register patents. You can come up with innovative ideas, innovative treatments. There's a lot happening in this space right now in the medical space, medical wellness. It's just, yeah, there's a lot going on all over the place. I mean, Peter Thiers, the Andrew Hubermans of the world and things like that that are really sort of exploding into the space. So these are the sort of things you'll think of in terms of your entity. If you bring on partners, how you crafting your agreements for future expansion, future growth, future partners. Later on, fundraising, these will come into play. Then you get into the regulatory space. The minute you register an enterprise, CRPC gives all that information over to SARS, and SARS then proceeds to give you an income tax number. And that happens automatically if you're registering an entity. The reason behind this is that SARS can then follow up to find out what's happening with this entity. Way back in the day, you would actually have to register with SARS with an RT77, RT77C to register for an income tax number. Well, that allowed a lot of companies to be formed at SIPC and then the old CIPRO, and then trade without actually even having an income tax number. that loop's been closed now. So the minute you register, all your information goes to SARS. SARS registers you for income tax, you being your enterprise, and then they can then follow up if no returns are done. So what we've done is we've listed these things pretty much in order as they happen. You yourself, if you remain a sole prop, you will have an income tax number, as I'm sure some of you are already aware, when you have to file personal tax returns. So income tax number happens regardless and almost immediately when you start setting up a vehicle to earn income. The next thing that happens is the minute you employ somebody and they are working with you, even if it's part-time, more than 21 hours a month, you have to register for UIF and then workman's compensation. So a lot of people get mixed up with the e-filing story where you can then sort of submit UIF online. What happens is that's a secondary step. You have to register with the Department of Labor as an employer, whether you're a sole prop or not, whether you're a company or a sole prop. You register as an employer, you get a number from the Department of Labor, and that means you now have to and deduct UIF. You also have to register for workman's compensation. Because if your employees, remember, anyone who works more than 21 hours a month for you, they are considered under your care, and then you have to register for workman's compensation. So they get injured while they're working for you. And a lot of you might sort of remember extensions from households where you're employing like and domestic staff. Homeowners have to register for workman's comp and for UIF. So it follows a very similar pattern. So those are immediate. The minute you've got somebody working for you 21 hours or more, UIF workman's comp, that's a mandatory. They'll come up, that'll be the next process. Pay as you earn only kicks in above about 97,000 Rand a year. So pay as you earn is mutually exclusive from UIF. So just remember that they're not tied in. A lot of people sort of varsities and things like that, or people who've coming out of varsity or going sort of got tertiary education, skip through that because they're already earning enough to be in the pay-as-you-earn bracket. So I've just seen there's a chat about independent contractors. So guys, yeah, I'm glad there's questions coming in. Please post them. And also, if you've got questions, ask in this chat. It is interactive and there's a lot of stuff. It's gonna be quite a steep sort of broad stroke chat we're going through. So just ask away. If it's going to come up later, I'll just mention it's coming up later. But it's always good for everyone to just learn because I'm sure if you're asking the question, the rest of the group's thinking the same thing. So yes, so independent contractors, if you employ an independent contractor and 80% or more of their income comes from you, you got to withhold pay as you earn from them. They will now be under your control. You need to pay UIF and workman's compensation. So 80% or more. Okay, so just look at that. So if they there's a test for workman's compensation that SARS has, and the two basics ones are if they earn 80% of the 80% or more of the income from one employer, they deemed to be an employee, and or if they get direct instruction from you. They don't have to work in your office. If they get direct instruction, so they cannot perform their duty without instruction from you. It's almost a de facto employer and relationship. So that'll go sort of from that link. There are, as all things, workarounds. We have a few workarounds in that space which we assist our clients with. You know, There is a question here. As a doctor, should you register as a sole prop or an Inc? So let's tie that in, and it's purely a personal services. It's purely a personal choice thing. Okay, and it's a personal choice thing in terms of income tax. So a sole proprietor as a doctor, you are held liable if something goes wrong. That's you yourself, because you are offering a personal service. Okay, so, and then all your profits are taxed as in your hands. Okay, so if you, depending on whatever your profit is, that'll be the tax table and you'll get taxed on that level. And Inc. is really a tax play because you still get held personally liable. That's what an incorporation entity means, is that you can't dodge from personal liability. But then you've got the opportunity for tax planning in your Inc. in terms of 27% of the profits are taxed, and then you go forward from there. So there is a little bit of tax planning around that, but just from a direct line of sight, 6 of one, half a dozen of the other. One is early costs. You might be starting out and not having a lot of money, and then being concerned, sort of startup costs. But in the professional industries, that quickly get stepped out within a couple of months. So it would really be, yeah, the only thing is like right in the early days. I don't have money today. But the moment you start locuming and stuff like that, boom, you're really starting to make money, which then moves you into the personal liability space and you're out of that cost element. Okay. So let me just, I've got a
Hi.
hand up here, Celine. Oh,
Yes, thanks. Sorry, I was
yes.
not sure if you saw it.
No, I
Um,
did. Thank you.
if you don't mind me asking, on the previous slide again, um, I know you're saying it's a personal choice, but I myself, and I think others have probably also experienced this. You know, you chat to different accountants, and one is telling you sole proprietor, the other one is telling you PTI, the other one is telling you Inc. So I think, yeah, without much background, it makes it difficult to know which one would be best. Can you maybe explain what the tax implications are with regards to the PTY and with regards to the Inc? Especially as we're starting out. And then also, even just understanding, um, like you mentioned with Inc., that there's a company tax of 27%. How does it work exactly if you draw a salary out of that, you are taxed on that? Or I don't know. Can you just.
Yeah. So further down the line, we got a tax chat because
Okay.
there's a thing called small business corporations tax,
Mm-hmm.
um, which comes into play depending on where you are in your growth cycle.
Mm-hmm.
So I want to just I'll go through that in more detail there, if that's okay, Celine.
Okay. Sure. Thank
Yeah.
you.
Okay, perfect. All right. Junaid has got a post. It's illegal to practice as a doctor, as a PTY LTD. So I'm going to speak under correction here. If you're a doctor and you're not seeing patients, you're doing a lifestyle, um, sort of lifestyle type of business where you doing like now, there's quite a lot of doctors doing wellness and health, where they're not medically practicing. So that's a business where they're selling wellness and health and maybe some vitamins. Then PDY Ltd is fine, they got a product. But if you're practicing where you are sort of dispensing medical sort of like a medical practice, then you need to be an Inc. because they don't want to have a separation between personal liability So that'll generally be the drawing line. If you're treating people, you will then obviously, you need to be held liable, which is why we have insurance and stuff. If you're selling a product, like in terms of a product service type offering, then the shareholders who invest in a PTY are separated from the owners who run a PTY, being the board and things like that. And they will be held liable for malpractice within being a director doing fraudulent activities or snake oil salesman, so to speak. If they're selling a product that is not doing what it says, then the entity and the board can be held liable, but it separates the shareholders from being liable, where the doctors are generally the shareholders because you've got to be a doctor. Like accountants, you've got to be an Inc. CAs have to be Incs because they then can be personally held liable for the actions of their company. So that's where the line actually gets drawn. Okay, cool. So I was going to go through then SDL being skills and development kicks in once your payroll exceeds 500,000 Rand a year. That's when skills and development kicks in. So it just gets sort of added on as your payroll grows over time. And lastly is VAT. And that'll kick in at a bar year. So 100, sort of 83,000 Rand a month in terms of turnover, if you want to break it down monthly. And regardless of whether you, as we said earlier, sole prop or a registered entity with Sub-C, you would have to register for all of these activities if you employ somebody. If you're paying somebody and their income is greater than 97,000 a year, they'll be pay as you earn. If the number of people individually are earning more than 500,000 Rand a year, there'll be STL. And if you're generating sales of more than a bar a year, you will be having to register for VAT. And that'll happen in your own name as well if you're a sole prop. Just unlike a company where the company is linked to the company registered number, this is linked to your ID. So it'll be, Tyron trading as Dr. No, if that's the case. And you will then get registered and you do all the normal e-filing things, fill in all the necessary forms when they become due. So yeah, it doesn't separate whether you're a sole prop or whether you're a registered entity, whether the regulatory environment kicks into play. Those things will happen regardless because SARS wants their pound of flesh. Yeah. Other things that'll come up to play, this is more in the realm of registered entities, but it's more red tape that you'll have to deal with as you're moving along in your journey. Annual return, so not to confuse with annual financial statements. When you have a registered entity at CIPC, every year on the anniversary of your registration, you have to then submit an annual return. And there's a small fee depending on your turnover. Well, it's small at the beginning, anything from as low as 150 Rand right up to 4,000 Rand, depending on your turnover. And this is just a stamp duty, like a penalty, effectively, that you have to pay annually. They've also co-joined it with beneficial ownership, because then you'll have to submit a beneficial ownership. Who are the owners of the entity? That's kicked into play now, but those things don't change too often. BE certification, there's a requirement. When you're under 10 million Rand, I mean, your clients aren't going to be asking you when they walk in the door, but organizations where you want to render your service, they might ask for your BE certification. And generally, when you're starting out now, if your turnover is less than 10 bar, you'll be an exempt micro enterprise. So that's what that would kick in that regard. And also tax clearance will come into play on occasion. And this has really been abused. The only entities that can ask for a tax clearance are government entities. So if you're registering with a government entity in order to receive taxpayer money, then that's when a tax clearance comes in, because effectively the government is telling you, before we can pay you with taxpayers' money, we need to be certain that you are paying your taxes. I know we read the news and we all see that's not really the case, but that is what that requirement is. A lot of corporates have rolled it into their vendor application process. So what we've done as part of our company registration cycle that we do for clients is we register them directly with a vendor pack, so that if we register a business for them, they'll get all the necessaries, the business share certificates, their EME certification. They'll get a tax clearance when we register their profile with SARS. So they could effectively vendor they're good to go for any vendor application. So that kind of helps with that. Another thing you'll come across is the Public Access to Information Act manual. These are sort of been paused for smaller enterprises and then not so much for larger enterprises. But generally for the smaller companies where you sort of under the 5 bar a year turnover range, there's not too much push to have that sort of access to public access to information manual. What the manual effectively is, for people who don't know, is it's how do the public access your documentation, your publicly sort of accessible documentation. And it shocks a lot of people to find out that your share certificates, your MOI, your company disclosure documents when you register, as well as some of your board resolutions, your annual financial statements when you sign them off and submit them to SARS. A lot of these things become public documents because of the nature of them. So someone can effectively come in, random person off the street, and ask you for your financials. And this manual explains to them how they go about accessing your publicly available information. Okay. It's been used very effectively, funny enough, mostly in the media, where you see in politics, where political parties have used this to get access to what should be publicly available information in the politics space. So that's been used quite a bit in that area. Employment equity has become a big one now with the change in the Employment Equity Act, and effectively anyone over 50 employees. So that's really, there's two elements to that. One is we all have to register to show we're less than 50 employees. And another one where obviously if you're above 50 employees, you've got to then submit your employment equity timelines and plans and things like that. And then lastly, of course, annual financial statements. You've got to prepare these within 60 days of the end of your financial year. That's part of the Companies Act. And then obviously utilize this for the submission of your income taxes with SARS. Okay, so there's a lot of things happening all the time that you may or may not be aware throughout the journey of your year, like your financial year that you operating like an enterprise. Sadly, a lot of accountants only focus on the accounting element side, things like getting your tax clearance from e-filing or drafting your annual financial statements. Very few of them understand the broader implications of share certificates, shareholders agreements, things like that. They're just not exposed to that space. So when you're seeking advice, seek advice broadly, because a lot of people are not geared for a very broad sort of spectrum in terms of what is required to run an enterprise. Okay. So just going through what we've gone through. Do you guys have any idea, just from the basic regulatory framework we've just spoke, and this is the basic, it changes by industry, it changes annually depending on the whims of regulatory bodies. But do you guys have any idea, just from the basics we've spoken about, how many forms you'll be responsible for submitting annually? Eh? Be interesting to see, just thumbsuck in the chat, sort of what are how many forms you guys think you'll have to be, having to actually submit. $11, too many. Yeah, that is so much red tape. Tegan, 11. Anyone else? Guess?
100 odd.
Some industries, yeah, depending on this, but for us, luckily not that much at this point. Yeah, everyone's very much on the low end. So just basically, your income tax has 3 forms. Not even your personal income tax. We add your personal income tax as another 3 forms. So RP61, RP62. So that'll be your RP6s in August and Feb when you actually pay your money over to SARS. The RT14 is a reconciliation, obviously, of that, and the potentially a top-up if necessary, or a refund if you've overpaid. UIF, 12 forms, and that's separate from the EMP 201 you do on e-filing. Workman's comp, one, obviously pay as you earn. There's 14 forms now because there's 2 EMP 501 recons. And then VAT, there's 6 forms minimally. But if your turnover exceeds 30 bar a year, it's 12 forms. You've got to submit VAT every single month. So that's just the basics. 36 forms without your medical registrations, without any of the other, I mean, we've got clients, your vehicle, your public driver's license, the liquor board, food, business license. So for some industries, it can very much well be upwards of 100. And this is the red tape that kills SMEs. And this is a lot of the stuff that small business owners wonder, what am I paying my accountant for? Well, this is the stuff you're paying your accountant for, or technically you should be paying them for. And it's part of your sort of thinking and your planning of where you're taking your business. So it's good to get a good idea of a lot of these stuff, and it's a lot. We have a product that we actually utilize called Snapshot that tracks all of these things for you. So when you guys are signed up with us, we have a reminders, a snapshot that tracks these things and goes forward from that. So you're always getting reminders where it's going and things like that. So these are just the docs. So let's now dive into the sort of accounting side of things. And the point here is not to teach you accounting, because not even accountants want to be taught accounting. What you're going to just go through here is sort of headline items, things that you should be aware of, and you generally will be aware of them. But it's also the terminology that gets used. So when you're going to financial institutions, when you're talking to potential funders or future business partners, these are the sort of things that are going to be asked, and, things you should be asking effectively. So basic books. And this is something every single business owner knows intuitively. You know who owes you money. Every one of us now, you know who owes you money. Junaid, are you not seeing it? Let me quickly stop sharing and I'll reshare. Maybe it might be a glitch because you've jumped on off.
I can see it. Yeah.
Okay.
Yeah, I can still see everything.
Everyone else good there? Okay, I was thinking maybe I'll stop sharing and then just reshare, but let me do that quickly and then I'll just reshare it quickly. Sometimes the internet, you know, what did they say? To err is human, but to really screw things up, you need a computer. Okay, so basic records. Your accounting comes down to these three things. And don't let anyone else fool you about it. It's no more complicated than these three things. Who owes me money? Okay, so if you're invoicing somebody and they haven't paid you, you know who owes you money. Those are your debtors. To whom do I owe money? So who do you owe money to? You know that because they're phoning you, asking you when you're going to make payment. So effectively, you've bought something from somebody and you haven't paid them yet, or you got a payment arrangement. So that is your actual creditors. And then how much money do I have in the bank? Those are the three things we live by. So I'm invoicing people, I'm chasing money, I'm paying suppliers because they're chasing me because they want money, and I'm checking my bank every day to see who's paid so I can pay the people who are chasing me. That is accounting in a nutshell. There's nothing more to it than that. So if you got the answers to those three things, so when your bookkeeper, and I'm purposely using a bookkeeper as opposed to accountant because your bookkeeper prepares your book. It's called bookkeeper and books because it tells a story about your business. Good or bad, it might be a horror show, it might be an amazing show, but the bookkeeper keeps record of those things. So when the bookkeeper asks you for these questions, who have you invoiced, you know, who have you bought things from or stuff like that, that is how they then build your books. An accountant is somebody that accounts to you. They then take that information and in meeting with you go, where does this all, you know, where are you going with this? The people you're invoicing you're not paying enough or they're paying too slow. And they then take those numbers and sit with you and hold things to account where it's going. Tegan, do all business owners even know half the information? Tegan, the scary thing is we've been doing this now because we run a few programs, EDST programs as well, and we train accountants. We're training 50 at the moment. Scary thing is very few people know the scope of the things we're talking about. And this is why we do this. The title for this talk was always what you needed to know, but your accountant never told you. That was the original how we did this. Because there's so much stuff. And I'm glad you're asking that because this is what and I say the accounting firm you deal with, they must have a broad knowledge of this stuff because this is the stuff that trips you up. Not oh, have you paid my VAT? Have you not? Unfortunately, if you don't know the things we've been through now, you're not going to be able to give your bookkeeper and therefore your accountant the right information that they can minimize your tax. Okay, so basic record keeping. Who owes me money? Who do I owe money? How much is in the bank? So that makes up your books. Those questions, those are the questions you ask our clients every month. And we use that information to produce your management accounts. And you guys would have heard of this saying, you know, send us your management accounts. And a lot of people are like, what does that even mean? So your income statement, when your bookkeeper is chasing this information, income statement, or nowadays they're calling it profit and loss statement, means exactly the same thing. It is, what is my income? Nowadays, profit and loss am I making a profit and loss on my day-to-day trade? So I've invoiced a number of people. It's cost me certain expenses. And have I made money out of that transaction? That's your income statement. Your balance sheet is keeping a balance of that. So I've invoiced a number of people. They haven't paid me. The balance on my balance sheet says my debtors owe me. I've taken a number of suppliers. I've got a 60-day account. I've been able to pay some of it. The balance sheet tells me how much is outstanding. Same as my bank account. It's telling you whether I'm in the positive, people are paying me, or I'm running into an overdraft. That is what it translates to. And your bookkeeper should be able to, at the press of a button, give you your income statement and your balance sheet. This is a moving target throughout the year of your company. It's a moving target. The only document that takes this moving target and locks it into place is your signed annual financial statements. Everything up until that point is a moving target, because today I can print off your management accounts and it shows you've got lots of money coming in, your books are looking good. Tomorrow you get the letter from your biggest client that they're going bust, and that R500,000 you're expecting now is to be written off, and tomorrow your management accounts show you're not doing so well. That's why it's a moving target. The signed financials is at the end of your financial year, we've stopped that moving target, agreed those numbers, and moved forward to then create another moving target going forward. So that's what these things are. If anyone's trying to make it way more complicated than that, they are trying to make themselves sound smarter and intimidate you into why they're earning the big bucks they're earning. That's what income statement and balance sheet is. And your bank will ask for it if you want to get a loan. They generally ask for it 6 months out from your financial year to see what's transpired from the hard and fast locking down the moving target being your annual financial statement. What's happened since then? Generally be a 6 month window. So that's what's important. And it's crucial for you to see what your income and your balance sheet looks like for planning. Okay. So this is the purpose of management accounts. And if you're not looking at this every month, you're doing yourself a disservice. It doesn't have to be a whole long half a day routine. You're tabbing certain things so you keep track of where you're going. So it guides like the decisions you're making, which is quite crucial. I mean, are you wasting your time in markets that are never going to return an income? Are the margins you're hoping to get going to cover your expenses? These are the choices you're making on a regular basis. Is the medical aid really going to make things work? Or do I need R500,000 before I start getting the money in? Where do I get that from? These are the decisions you end up making by looking at your management accounts. I've got a bit of slides further on that I'll show you where you can see it and when it makes sense. Obviously, understanding your sales streams and cycles. You guys are on this program. You've heard Chad and them give you this couple of income streams coming directly from this program, but there could be multiple income streams, and these things are seasonal. What happens? There's a definitive baby birth cycle in South Africa. There's a definitive flu cycle in South Africa, and this is globally. You can see it globally. Following seasons. Have you looked at those seasons? Have you looked at those trends? Have you planned for locums? Have you planned for holiday? This is where this management accounts come into play. It's not just a hit and miss and just, well, I hope tomorrow that people are going to walk in my door. Know when you're taking time off. Know when you do. These things are so clearly defined. And if you're looking at your management accounts, you'll see it a mile off. Okay. Matching correct costs to expenses. You'll see this in your industry. It's quite important because you're utilizing a lot of consumables that have to be billed to particular clients and things like that. Luckily, we've got tech that helps a lot with this stuff, but looking at the matching of these costs, maybe you have to buy a whole lot of stock up front and you're going to earn it out over a period of time. What does that look like for your cash flow planning? Things like it. This is the key to management accounts. Tegan, would you advise multiple streams of income going into a single account or going into different accounts? That's very individual. So what we would do is, if you have to share that income with somebody else, I would then have a separate account, because if there's ever a question, you can just give them the bank statement and go, here you go, have a nice look. And that's a very simple way of doing it. But if you don't have to share that revenue with someone else, then there's no specific need to do that, because bank accounts come with their own costs. And then there's cash flow allocations between different accounts that gets untidy for people to track. We do like to recommend clients having a SARS account. So when you get into the VAT cycle numbers, automatically put your 15% VAT into the VAT account. And then what you find is you never pay 15% because you're incurring VAT costs. In our industry, maybe yours will be the same. You're paying probably 10 or 12% of the VAT across. Other industries are only paying as small amounts, like 5 to 7 or 8. So you're going to accrue funds in that account, which then you can utilize for other things. It's like a slush fund, a savings account. So that I would actually recommend. But in terms of splitting each income line into their own bank account, I just don't think the cost benefit. And then the actual bookkeeper's questions for when you're doing inter-account transfers, what is this, what is it? Because us humans are lazy. We don't put the right and descriptions on the transfers. So it's harder to track. And at the expense of offending the doctors, we don't want to ask you to write a note because no one can read them. So yeah, no, just joking on that. But that's kind of where if you're one of those people who are very sort of detailed and you're making the right notes on your bank statement, do the thing that makes you happy and then move on from there. But don't do things just for the sake of doing them. Cool. Okay, so we've covered that through. So your income statement will generally be sales, less your cost of that sale. And we're quite aggressive in terms of how we do that. Any expense of yours on which you make a margin should go under cost of sales. A lot of accountants don't do this. They just use the standard chart of accounts inside the accounting platform that they use. And although it doesn't affect the bottom line, the net profit line, whether your expenses under cost of sales or under overheads, is not going to change your net profit line. But what it does change is it changes your understanding of your business. Because overheads should only be those things that you would spend regardless of whether you've seen a client or not. So the things that you need to pay just to keep your doors open. So I need fuel to get around to see things. I need a way of contacting clients or having clients contact me, be your phone. I need to be able to get to my client, get back, vehicle, whether it could be public transport, that's fine, Uber, whatever, those things. I need monthly accounting regardless. I need to pay my registration subs, my insurance, my practice insurance. Whether you're seeing clients or not, those are the things. If I've got a staff member, I need to pay them whether or not I see clients. If you've got a subcontractor who you make a margin on, so you send them out to see clients and you bill 500, but you pay them 300, they're a cost of sale. Because if you don't have work, you're not going to be hiring them. So just think about those things and be very, very brutal. We're quite brutal on it because where it kicks in is here. Your net profit, especially in the early stages of your business, but I want you to think of it in this, your net profit is all of your salary. No business needs to have a profit at the bottom here to pay SARS income tax. Profit at the bottom here is a vanity. Okay? So you can either take it all out under salaries and wages, pay yourself out completely, therefore there's no profit, and you only pay as you earn or income tax if you use an IT3A. So all of this, what would be net profit, is your salary. It's all yours. Now, if you work backwards from this example and you go, I want to make R1,000,000. Here's a simple number, R1,000,000. That is, I want R1,000,000 gross income. It's 83,000 Rand a month. Okay. So how do I get my net profit to be 83,000 Rand a month, or cumulatively 1,000,000 Rand? So you take your R1,000,000, you add back all your operating expenses. Okay, you add back all your operating expenses. So now your R1,000,000 becomes 1.1 for the year. Depends, maybe let's make it 1.5 for argument's sake for the whole year. So now I need to make enough sales, and then the cost of those sales, if I subtract those costs of those sales from my sales, my gross profit has to be 1.5 million for the year. But now if my cost of sales, if I'm only making 10% margin, I'm going to do a hell of a lot of sales to make 1.5 bar GP a year. If my cost of sales are high, like think of ShopRite, they make 6% gross margin, gross profit a year, but they're selling billions a year. So their profit looks nice and big at the end of the year. You think, wow, look at them. They made 30 bar. But that's, and the guy who sells airplanes sells one every 3 years, but he makes the same amount of money because the margin is so much higher. And why we say this in terms of understanding your books, because that is where you're going to do your planning. You're going to see where your sales cycle, as my sales is growing up, coming down, boom. Now you can plan your cost of sales. Oh, in big months like this, when I'm making 400, I'm buying these expenses here, the 183, they coming into the sales here. I could buy in advance because I know my margin's going up. I know where my planning is. And that helps you with your planning, helps you with your pricing. What a lot of people forget, especially us who sell time, you got 1,600 hours a year. If you want to have a life, you got 1,600 hours a year. You can work more than that. You can work less. So whatever you want to earn, and I mean earn is take home like cash money, at the end of the day, divide that by your, take that amount and divide it by 1,600 hours, give you an idea of where you fit in the scale. And then your experience accordingly. A newly sort of printed accountant might be able to charge out for 250 an hour. A way more experienced person goes up 5, 6, 7,000 Rand an hour. As you guys know, in your field, a new doctor and a specialist, totally different. Look at that element. Okay. Junaid, in terms of tax, better to pay salary or net profit? Personal sort of choice, depending where it fits in, depending where you're on the scale. But that'll be a conversation you need to be having with someone. Like we do this with our clients on a regular basis, looking at that. What is that number going to look like at the end? But there are occasions where pay as you earn is almost like forced savings in a way, because if you follow the tax table using pay as you earn, and then you submit your personal income tax, and the less your medical aid, less your RAs, less, you end up getting money back. It's generally the formula. Or you can just do a provisional tax, get an RT3A, and then just pay the income tax twice a year. That might work out for you. So it varies sort of heads on. Celine, I'm glad you're reading the screen, because general expenses, 100%. I'm glad someone spotted that. There's no such thing as a general expense. I know we live in a country where generals you're able to purchase them, but generally there's no store where you can go buy a general. That's lazy accounting. If any bookkeeper ever gives you a book that says basic account, like general expense, there's something in there. That general expenses, entertainment, it's marketing, it's something. You spend money on something. So well done for spotting it. That's a direct red flag for SARS. They'll audit you, 100% audit you. Okay. You can't use your net profit for personal expenses. So your net profit is a figment of your imagination. You can take all your money out every month. So the sort of, there's net profit before tax and net profit after tax. So before the tax number, you can take the whole amount of what would be considered net profit and pay it to yourself. And then there's no profit, so there's no income. And then you can do what you like with it because it's yours. You've paid tax on it. Or you can decide, I'm leaving money in the entity for future growth. And then you pay company tax on what's left. So there might be a profit of 1 million. You take out 500,000, you pay as you earn on that. And then the 500,000 gets 27% income tax on it. And the proceeds remain inside the business. This will show generally what you'll find here. It will sit under current year earnings, equity. So your profits build up into this space here. Okay, so this is what your balance sheet will look like. Balance sheet is effectively balancing your assets against your liabilities. Your liabilities cannot be more than your assets. Otherwise, you are insolvent, and it's illegal to trade in insolvent circumstances. Although, admittedly, a lot of startup enterprises, do trade in technical insolvency. And what that is where you funded the startup of your enterprise. So the liability comes under here. The company owes you the money back. You're not going to sue yourself. So it's a technical liability. Okay. So that's sort of income statement, balance sheet, and then sort of going forward from there. Okay. Celine, you're doing an audit on the books as we're going through it. Historical adjustments would be things where something's changed and you need to bring in that adjustment. You could have, you start a brand new business, you funded the setup of that company beforehand, and you can bring it through your loan account, or there was a mistake, say SARS overcharged you and you're adjusting it. So that's what those sort of historical adjustment. You're just fixing a mistake from the past and stuff like that. But no, I'm glad you're asking. Don't ever apologize. Please, this is what we want. So, and these are just nice examples. but these things will change for each of you and where you are. So this gives you the importance of understanding your book. So when we look at management accounts, I'm going to go back one stage. If you meeting with your accountant and they're not producing your management accounts in this format here, I don't know what they're doing, because how are you supposed to track month on month changes? How are you supposed to see trends? How are you supposed to spot expenses that haven't been recorded? Because you're thinking in your mind, nobody knows their books better than the person who's got the answers to these three questions. And if you running the bank account and you are doing the EFTs and you doing the invoice, you know these questions. You've got the answers, and you'll so quickly spot where your bookkeeper has made a mistake and called it general expenses, as opposed to, no, those flowers in the reception are part of our office expenses, or they're part of our, what else can we put them under? They could be under, but it'll normally be office expenses because it's for beautification of your office and stuff like that. So, and you can spot that and go, no, that must go there. I don't want to be audited by SARS. It can't be a general expense. So you should see your stuff like this. I'll show you a slide later from our snapshot tool that we were talking about earlier, and where this, so why we use Xero, and it ties directly into that product. So good financial foundations is you looking to the future. It's giving you a crystal ball into the future. Where am I going from here? Or how do I get to the goal I have in mind? Okay. Positive cash flow is king. Ideally, you want cash clients coming through the door, and you're paying your suppliers 60 days from the day they dropped in. So you've got 60 days to do with that money and hopefully make, turn it into even more cash. Revenue completers, your books must be complete. Complete in the sense that all your revenue, all your expenses are in there. So you can make the right call. You can then decide which way to go. Accounting systems. Yeah, accounting systems, guys. Accountants are lazy. They're like the rest of us humans. We are lazy, and we'll use the default settings on everything. They can change those chart of accounts. These elements in here don't have to be in this order. They don't have to have the following sequencing. You can break your revenue by region. You can break it, like in this case, it's detailed. You can have it by procedure. These things can be set up in a way that the minute you look at it, it gives you a complete understanding. And that's going to come from having the systems set up. Not that you have to do accounting, but you can look at it and go, no. Why can't I see that thing I'm looking for? I need to track my margin on my staff. And it can all be done. It all becomes an Excel formula. And then lastly, you want to stay out of trouble with SARS. SARS is on a massive hunt. Put it that way, maybe a money grab would be more accurate. We were at a seminar the other day, and they are, I would go so far as to say they are breaking the rules. They won't say that, but they are breaking the rules in order to entrap taxpayers. Probably be right, where they want to separate you from your accountant so that you will say something that could inadvertently lead to an audit and an additional claim of taxes, would probably be safe to say. And they're ramping up, and they're using tech. And they're counting on the fact that you do not know what we've just told you on all these things and all these expenses. Tegan, correct me if I'm wrong. So Ubers and cups of coffee, lunch, see. Okay, I'm going to tell you something that no one's probably told you, Keegan. And guys, this is important. What can you claim? It's coming up in a slide here, but this is probably as good a spot. Any expense in the production of income, any expense, if you can draw a line between that expense that you've incurred and how it's benefiting you from earning your income, claim the expense. I'd rather have SARS fight with us and say no than you never claim it, because then the answer is definitely no. So any expense. If you're looking at that slip and you're thinking, I wonder, accept it. We got tech that makes it easy. Product called HubDoc. It ties in with your accounting platform, Xero. And if you can take a selfie, you can keep your books up to date. You literally just take a picture of your slip and it codes it directly into your accounting platform. So anything. So yeah, so to any expense. Okay. Precisely, Rule. That's exactly it. I'd rather they come back and say to us, no, but then we're not going to accept that. We're going to tell them, tell me why, where in the law. And if they can show us where in the law, then we take it out. So, and we've got a lot of experience with this, so we'll guide you guys on this process. It seems like such a massive learning curve, but what it is, it just becomes this an awakening, because as you start pulling on these strings, you start going, oh yeah, cool. And we're not going to teach you accounting. We're going to teach you to look at your business. So when you hear a thing on the news, or you see something in print or online on X or Facebook, wherever you're getting your news, your first thing must, I wonder if this can work in my business, or I wonder how this is affect. You can reach out to us immediately and we'll tell you how it's working. So you can buy groceries. If you're running your office and you are providing staff lunches for your staff, or you are, I wouldn't call it groceries, because that's more of a household term. But if you are stocking your canteen, then 100%. You can go, if you grab a snack or you grab something at the canteen, those are expenses. So anything, guys, rather bring it in, we'll look at it and we'll go, okay, now, that yacht you're buying, unless you're taking all the specialists out, to the med, okay, yes, it's a marketing tool, 100%. But so obviously we're joking a bit about it, but yeah, we go from there and we'll look at the expense, we'll look at the line that you're drawing to your income, and then advise accordingly. And this is, again, it's not thousands of hours of time. It gets going through. So Celine, yeah, so there's a thing, you say canteen for one, and we're joking, but like things like sales reps and things like that, you're on the road, even if you're locoming and you're running between practices and you stop and you grab something to eat and things like that, that's at the production of your income. You're out there on the road. There's like an allowance. It's like 50 Rand a day. They used to call it smokes and cokes. And it came from the sales reps running around doing sales, where they could pop into the corner cafe. Now we've got obviously the Petro forecourts because the cafes are gone. And these were 50 Rand a days of things that you could just grab a sandwich, grab a cool drink, sustenance effectively. That's 2.5 grand a month. 2.5 grand a month. Semantics are key. So let's just rather take a picture on HubDoc. We'll have a look at it and we'll argue with SARS. So these are the things to think about when you cash flow planning. Obviously, less cash means you got to chase people more often, or you got to get more clients. So look at your margin, look at your pricing. Don't just accept what somebody says. You might have a better value proposition, and although the industry might say blah, 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 you go, well, my value proposition is X, and it would be cheaper for me to sit on the beach instead of working for what you're offering. Then sit on the beach, because when you do get paid, you're going to be paid properly and your margins are higher. Look at how your expenses are being sort of tracked. Are they daily, weekly? When do you need cash for these type of things? Are you getting paid daily, weekly? So understand that thing. Crunch dates in your life cycle. These are sort of the main key ones when you're up and running, but look at crunch dates that you can't avoid. Payroll for staff, yourself, because you've got bills to pay. VAT, obviously, your suppliers, who you got to pay as you earn if there's high enough income. These are hard and fast. They incur penalties. Penalties from SARS is 10% of the bill, plus interest thereafter on a daily basis. Suppliers could give you obviously interest and or not supply you actually going forward. So understand these and hard code them into your cash flow. This is why these things, looking at this, is important. Because if you look across the line, the average year I'd say would be 100K a month as your OPEX. So make sure you got 100K a month. You're probably going to trim this if you go forward, but just on a quick line, you can go across and go, we're averaging roughly about 100K, give or take, probably 80, get away with 80. Boom. Am I getting 80 by month end so I can make this happen? That's what management accounts and cash flows for. Okay. Budgeting. This is important in your early stage where you're going forward, because it's a forward thinking. Obviously, there's a lot of practices out there where you can get rough guidance. I mean, Chad's can give you rough guidance. He's given you guys sort of one of the chats in terms of expected earnings and things like that. But budget, especially the first year, budget is harder because it's a thumb suck. And that's what it is. It's you really thumb suck. And then you get out in the real world, and what did Mike Tyson say? You know, until you get a smack in the mouth, then you realize if your budget's working or not. I'm paraphrasing, but your budget will give you an idea. So, and that's important. Look at your budget, look at what expenses, what capital. If you have to buy capital, I need a car to get around. But nowadays we can use Bolt, Uber, InDrive. There's a number of transportation services that get around capital. Online tool offerings, things like that. You don't have to buy phone switches anymore like the past. How detailed should your budget be? This is going to start out very simple in the beginning because you don't know what you don't know. And as you move forward, it's going to change. And it's going to, yeah, you might want to change your income statement by product sold, by racial group, by province. I mean, you could come up with all sorts of things that you want to do. And that'll grow as you're drilling down into your information. How much must I pay myself? We say as much as humanly possible. And it's important for you to have this number in your head in terms of what you want to, and you got to be realistic in terms of, I can't be a first year CA and thinking I'm going to earn 2,000 Rand an hour. That's not going to happen. I'm going to get there, and I might get there quicker because I'm smarter, or I've done more additional things, or I've just got a circle of very rich clients. But be realistic and understand the market for where you fit in terms of your pay. And I'd say even go ahead by 10%, maybe even 15% of what that is. Where this is important is going to kick in here. So when you're doing your budget, let's just assume this is going to be your budget where you're planning. put your salary in here, the one you want to earn. And why this is important is we see this with a lot of entrepreneurs. They forget to include themselves into the costs because they're going, no, but the profits are mine. But if you don't have yourself in here as a salary under operating expenses, you won't be able to price your sale. Because if I want to earn 10,000, here my OPEX, the difference between 10,000 on let's say running my basic little startup might be 15,000 Rand a month. And then I add my 10 grand. Let's make it a bit more realistic. I may add 40 grand. So it's 50 grand now that my OPEX is. If I haven't added my 40,000 Rand a month salary into this OPEX, I don't know that I've got to mark my costs up. So if my sales, so let's say my costs for me to be running are 20,000. So if my sales are not 70,000 sales less 20,000 costs, it's going to give me the 50,000 needed to cover my OPEX. 10 grand for my phone and my travel, 40 grand to pay me. If you're not in here, you're not going to get paid. Don't make the mistake every other startup does and forget to include themselves in the cost. You are the most important person to pay. If you're not getting paid, nobody's going to get paid. So that'll determine whatever you're going to determine as your income, reverse engineer it backwards. There's already in cost of sales. I've seen from some of the slides, there's, I think, 20% certain rebate fees. So that'll be a cost of sale. So what does that look like in terms of number of sales I need to make? How's that going to impact my net worth? Is there a recommended pricing? Can I charge more than that? These are questions you're going to be asking yourself. And if you get stuck and you want to ask, we're the guys to ask, because we'll do this and we'll let you know immediately if it's a hobby or if it's a business. If you're not making a profit, it's a hobby. Unless you've got rich parents, that hobby is going to end very quickly. Okay, cool. Things that a lot of people forget to add in their income, just highlight real for you guys. Interest income you're earning, you got money in the bank, interest income, or if you're getting massive discounts received from suppliers for getting their product into the market, those are sort of deemed as income. Expenses that often people forget, you're paying something from your personal account and then you forget to put the slip in. That's money you've earned and you've paid tax on. So very important that everything, get it into the system as early as possible. Often people go, oh, I haven't given the bookkeeper this invoice because I haven't paid it yet. Well, that's going to mess up your VAT because you can't claim the VAT on it then. Home office expenses, you can claim home office expenses. A lot of people don't. And I put your fines and penalties. It's good to have them on your books, although you have to add them back for tax purposes. It's good to know, like, for example, you've got a driver. I'm the guilty one. I get a lot of fines because I want to race everywhere. But if you've got a driver utilizing a vehicle, or your accountant's forever submitting your VAT and pay as you earn late and you're getting penalties, it's good to know what these are so that you can deal with it. Rein the driver in, fire the accountant, fun things like that. Okay. I touched on earlier about a small business corporation. So all of you at the early stage will be considered a personal services company because you yourself offer the service. Us as accountants, we are a personal services company. As usual, there's always workarounds. Small business corporations will generally be business turning over less than 20 bar a year. You're not a personal services company. You guys are, because you're the one doing the work, but there's a little asterisk, so there's the caveat. The owners of your business are actual people, and you own only that business. Okay? Not more than 20% comes from professional services. You do that. A lot of it's professional services, and you must be registered. Yeah, those are the basics. What the little asterisk is, if you employ 3 or more people who are not family or related parties, then you'd also no longer a personal services company because you've got other staff. So if you have different streams of income and they doing other elements and stuff like that, it goes through from there. Okay. Yeah, and then there's tax savings around that. I just want to go through then quickly. There was a question. I don't want to, I think Melinda asked if I'm getting it right, where taxes come in. So these are the tax rates in your company. So if your business makes a profit of 95,000, these change every year when they do the tax tables, but just indicatively to see, you're paying 25,000 Rand income tax. That's a standard tax rate, 27. If you're a small business, obviously this is a sliding scale that sort of slides through. So you have you get a 90,000 Rand saving over time. But if you're not a small business, 27% of your company's, 27% of your company's profit goes to SARS. So now when you come to your personal planning, if your business has a profit of in these ranges, there's personal tax tables, and they're sliding scales from 0 to 45. And obviously zeros are under the 95, and then it goes up to 1.7 bar is like 43 point something, and then above 1.7 a year, you're into the super tax where you're paying 45. So up until that point, any profit your business makes, it makes more sense to take it all out and pay as you earn, or just do an IT3A and you then pay income tax on it. So that's kind of what you want to, where you want to do your planning. And this is a conversation we have with our clients all the time. It goes on throughout the year. As we're looking at your books, as we're meeting, it goes throughout all the year. Okay. I just want to jump onto one more slide. So this is what the snapshot tool looks like. Your zero numbers pull in here, and you get all your reminders when things are due. It calculates all your profit margins for you, shows you your cash flow and things like that. So very quickly, you can see at a glance what your business is doing, where it's going, and stuff like that. Okay, so that's kind of business 101 in a nutshell of where it goes. And it's a continuous cycle. So as also dropping the company profit by paying yourself would also decrease your small business tax. So remember, profit is a vanity cycle. You can take all that money out and just pay income tax on it, because there's no reason to pay both, to pay company tax and then to go pay dividends tax if you're going to take it out that way, because the only other way you're going to do it is take it out via salary. So the cheapest route at the moment is just paying pay as you earn. So take it all out, pay as you earn. The only reason, we haven't found too many reasons for keeping the money in the company in terms of a tax planning sort of thing, because ultimately we want more cash in our hands. So we look at, depending on your lifestyle and where your business growth and what your plans are, we'll structure it from there. Is a non-profit included in that? Well, a non-profit by its nature doesn't pay tax because it's a non-profit. There's no taxes on that from that point. Okay, so Danika's asked me just to explain our role. Okay, as you can see from our little slideshow, our role is we can do a lot. We guide us. So what we're doing when GoGPs approached us, they approached us because we're running another program or multiple programs, and they see what we're doing for the SMEs on that program. So besides doing bookkeeping, mentorship, taxation, there's other talks we do like this around, different cycles within your year and things like that. We process everything to do with running your company, from registration, the start cycle, right the way through to sort of mentorship from your books, your bookkeeping, making sure you're registered with the right regulatory body at the right time, keeping you abreast of all the sort of regulatory and changes that are happening, all the time in this space. Then moving beyond that into tax planning for you as the shareholder and for your business. How does that look? Where's the best split? What would make the most sense? When you bring on a partner, what does that look like in terms of shareholders? When you buy a property, what does that look like in terms of, is it a property in your business? Is it a property in your personal name? You want to exit, you want to, the sort of endless cycle of running a business from registration until you retire or you close down. We run that whole cycle. So on this program, we've been invited on it, is to take you guys on that journey. So while Chad and them are introducing you to these products, into the markets where you're going to be moving these products, we'll be looking after you in terms of where you're going, where you're taking your business, what does it look like in terms of tax planning and things like that. So what we've done is we've actually given you guys a discounted element in terms of what we do. So here's our simple product where you guys are on. I mean, obviously our startup is your company, your registration. This is what I was touching on earlier. This is like a complete vendor pack when you register your entity, whether it's a PDY, if you're not going to see clients directly, or it's an Inc. We go through this, your new company, your inaugural minutes, your share certificate, income tax, EME affidavit, tax clearance. We were working with someone to do bank accounts, but we discovered it's quite a personal people. I mean, like Investec, you qualify as a doctor, they want to throw a bank account at you. So that might be the best plan for you, but you would have all these other regulatory docs needed to make that process happen. So that's where we're starting our cycle with you. And then we go through forward into this thing. So the SME Simple product that we're offering is really just taking care of all these regulations. We don't do any bookkeeping, although for you guys, we're going to be doing the actual bookkeeping. It should be the next package up, which is the next one along where we do bookkeeping, the scale up, where it's like 5,500 Rand a month, but as you're going to grow into that. And we make sure everything from running your business, regulatory SARS, COIDA, CRPC, annual returns. There's just a fee that you'd have to pay to annual return to Sub C. But we look after all of that. Do your bookkeeping, get you discounted rates on your accounting software, include HubDoc into your accounting software, include the snapshot analytics tool into your accounting software. So what it does for you is, as you're growing on this journey, you're going to need numbers for institutions. You're going to need numbers for, how do I finance my vehicle? How do I finance my home? How do I finance my practice? How do I better improve my allocation of cash, my allocation of growth? Is expanding my practice gonna, when I hire the one extra person, is their salary of 30,000 affordable? And we're going to point out, well, it's not 30,000, it's actually 100,000, because your 30,000 you're thinking you're going to pay them means more space, means more hardware, means taking you out from your day to day to coach them into your way you're running your practice. And then they're only productive. How do you make that work? So that 30,000 is 100,000. Your cash flow doesn't allow it at this point. How do we structure that? How do we? So this is kind of where we sort of, the role that we fill. There's the programs we run for a whole lot of like mining companies, for EDs, the youth empowerment services, their programs and things like that, to essentially hold the hand of startup entrepreneurs. So we kind of run through the cycle, and obviously as the business grows, so accordingly does the fees. But effectively, for the remainder of this cycle that you guys are, you'll stay on this actual package. Some of you are going to exceed it rapidly, but you win. This is kind of where we fit into that, to make sure these things go through. Celine, so must you add VAT to what you invoice? Say your rate is, so what'll happen is, only when you exceed R1 million, there are occasions where registering for VAT voluntarily before you reach the R1 million cycle makes sense, but that can be explored with each of you. But generally, only once you've VAT registered do you charge VAT. And conversely, obviously, you can only claim VAT once you've VAT registered. There are circumstances where it makes sense to do it now, early stages. But yeah, we run through all of those things. With this able to do our own billing, yes. Ideally, with we're going to set up a chart of accounts standard on all the accounting packages, where the lines of revenue will come through. I mean, this is the analytics tool here, but we sign you up for all of this stuff. I just want to find so all of these elements in terms of your line items, we set up in the chart of accounts. I mean, we show you how to use Xero. We don't teach you to be accountants, because that's a waste of your time. You should be focusing on making money. And the system is intuitive. So a lot of the Xero, Ed's on the call here. I mean, he's generally going to take you through it, set you up, set everything up. You can have recurring billing. The system will do the recurring for you. Things like that. So that's the role we play in the cycle, in terms of it. Yes, Celine, I'm trying to just understand. You don't charge VAT if you are not VAT registered. If someone is charging you VAT, and you must then make sure you can mark up above that. That's what makes it a bit unprofitable sometimes, because it eats into your margin. So if you VAT registered, you can do the pass-through. Also, if the person you're billing, and invoice 2 was paying VAT already, well, you shouldn't be. If you were charging VAT and not VAT registered, technically you owe them a credit. or SARS is going to take 15% of your sales and then charge you a penalty and up to 200%, things like that. So if you're a doctor and you're billing a medical aid, if you're not into the right turnover, then you may have to do a voluntary registration, things like that. So it just depends on each of your guys' circumstances, and we can look at that. There's a sneaky thing with SARS, unfortunately, with VAT. A lot of people are unaware of it. If you have a business plan that you're shopping around for funding, and that business plan shows that you're going to exceed R1 million in the course of the next year, SARS is saying that is proof that you knew you were going to be exceeding R1 million and you deemed to register for VAT from that time. So just be aware of that, because the VAT registration thing is not, am I turning over R1 million? It's, are you going to turn over R1 million within the next 12-month cycle? Not the next financial year, the next 12-month cycle. So if you do a business plan and send it off to someone and go, yeah, look, I'm worth lending money to because I'm going to make whatever amount over R1 million, you have projected to make over R1 million in the next 12-month cycle. Therefore, SARS will say you knew you should have registered for that. They never used to come after people in the past, but what we're seeing now lately with their hunger for cash, they're starting to come out after people. There's an interesting thing. I was chatting with Chad regarding invoicing, medical aids, private clients. I have my own theories on this stuff. I don't think you should change your invoicing in the sense that we see it in our industry and we see it with clients we help. I'm going to invoice you. I going to charge you 10,000. Well, look, use our invoice as an example. Like, I'm going to charge you 3,000 Rand a month for all this bookkeeping, consulting, submissions, advisory, things like that. But you are not earning enough, so you can only pay me 1,000 Rand a month. So what happens is I go and say, okay, I'll only bill you 1,000 Rand a month. And when your turnover increases, I'll bill you more, or I'll bill you the deficit so we can catch up the deficit. And then in 8 months' time, you're going to invoice for 20,000 Rand and you have a heart attack and go, what the heck was that about? Knowing full well what our conversation at the beginning is. And we see this with the clients. So then they invoice somebody, and in their conversation with them, they then discount them. So they give the client the invoice already with a discount in. So the 3,000 Rand invoice becomes 1,000 Rand invoice. And a lot of people then forget that there was a discount applied. So our approach always is, even if you do work for free and you're going to give somebody 100% discount, invoice them the full value. So your practice, if you've determined what rates you're going to charge for certain services, that is what you must invoice on your invoice. If the medical aid is only going to pay a lesser amount, and therefore when that client's bill gets submitted to the medical aid, you're now not going to recoup the difference from the client, you then discount that invoice. So then now the client can see very clearly they're getting a discount, or the medical aid can see very clearly they're getting a discount. That cash clients are paying 500 Rand, medical aid is only paying 380 Rand. Where are we going from there? So look at that. And then sort of look at your billing. So yeah, for us, we go and say, you get a 3,000 Rand invoice. You can't afford to pay 3,000 Rand this month. You'll pay 1,000 Rand. And as your cycle increases, your earnings increase. So you'll then know you got an arrears and you'll catch up that actual payment. So that by the time you up and running fully, you into your 3,000 Rand a month and things like that. So things like that. So just to understand how your invoicing goes. Azar, sorry, you were saying? So dropping the company profit, let me just scroll back up to the question. So dropping the company profit by paying yourself would decrease your small tax. So Azar, just to get back to that, paying yourself could remove the entire profit, so that you don't have to have a profit in your company. You can pay the whole lot out to yourself, and there's no tax whatsoever. If you're a small business corporation, there are tax planning tools where you could lower your, there's a sort of line in there where there's a combination of company tax, dividends, personal tax that is optimal. But that's a conversation for each enterprise and things like that. Oh yeah, you have to pay income tax. Caesar's not going to let you go. If your gross income is higher than 95,000 Rand a year, you will pay income tax above the amount that's a rebate. So you might have medical aid, you might have RA, you might have things like that, which are income protection plans, and those things are allowable to claim as a rebate. So yeah, these just all become personal to each individual in terms of how much income tax. But everyone who earns an income pays income tax, or they're rebated to the point where the income tax is nil, but you will pay income tax. The minimum threshold is 18%, and that then just goes from there. Ken, pay as you earn will be the same depending on a sliding scale. You either pay as you earn monthly if you're drawing out an income monthly, or if you're taking an RT3A and you then paying out RP6 and you pay income tax twice a year. So it'll be personal circumstance. Celine?
Hi, sorry, I just thought it will be easier to ask
Yes.
like this. I just want to understand, with the services that you guys provide, is it including billing, or would we need a separate company or entity or to figure out billing on our own?
So generally, what we would do, we do invoicing for certain clients. It depends on the volume. It would be an extra fee. But what we're finding is, it's a personal thing in terms of, like, even with our pricing that we showed, let me just give you an indication. So even with our sort of generalized pricing we have for our clients, you might turn over 5 million, but you won't pay 9,000, for example. This is just an example I'm using. We have clients who sell sports cars, and the guy sells 2 sports cars a month. He only has 2 invoices. So it'll vary according to your business. That's generally volume. All the bookkeeping element, the bookkeeping cycle is what you end up paying for. It's the volume element. You with me? So that's what people normally end up paying in terms of work. You pay for volume. So if it's early days and it's a couple of things here and there, or we can automate it for you, we'll automate it. But if it's high volume and things like that, then I'd say let's have a look at it and judge each one on the circumstance. Does that help?
Yes, thanks. I see someone is saying that you can bill from the accounting platform.
Yeah, that's Ken. So the Zero accounting platform that we're setting up for you guys, that you can auto bill, or you can a lot of the stuff it can be set up. So it'll depend on how you want to run your practice. Some people are very anti-tech and use of tech. Other people are very into tech, and we'll help you fit into what works for you for your actual practice. I mean, we got doctors who use ChatGPT and they record all their meetings with their clients and it transcribes to text so they can bill afterwards. There's a whole lot of different things. And we like tech, so we develop a lot of our own tech as well. We're not debits and credits. We entrepreneurs first.
Okay, thanks. Yeah, no, I'm just in the beginning when you're trying to decrease expenses, because I know like some billing companies, then they'll charge another 4% on every transaction. So
Yeah, no, that's
yeah,
crazy. We don't do that.
yeah,
It's counterintuitive in terms of, like, we see payroll companies as well, and they're charging 100 Rand a payslip, and you're thinking, but that's like 5 minutes work per payslip. How's that $100? So it's ridiculous, and you get those. So yeah, there are those companies that are exploitative. Um, but we, as I was saying earlier, we work with our clients and we set things up to make your life easier. And you're going to get these inflection points in your life when you employ the first person. What is the headache you're going to encounter in your business? And part of our talks that we do, because we do these talks every month, is to tackle those inflection points. Who is the first person to hire? When is the good time to do it? What roles do they fulfill? And things like that. Because ultimately you want to actually be focusing on your end of the thing, that why are you doing what you're doing? Not doing accounting or books or bloody invoicing and stuff like that. Although for me, it's one of my favorite things. I always joke, my two favorite things, invoicing our clients and then spending the money they pay us. You know, so yeah. Okay,
thank
Ken,
you.
you said you want to share Zero quickly. So Ken's our ops manager.
How's that, everyone? Yeah. Taryn's explained holistically everything our services and offer, and obviously included in that is the accounting software. So I didn't, before the opportunity runs away, I just want to give you a quick uptake on um, what you can expect and what comes with our packages. This is the receipt gathering tool. This is an app on your phone and on your laptop. So as Tyron said, you just need to take a selfie. So if you fill up at the petrol station, there's an app on your phone, you take a photo of the slip. You can then lose the slip once it's uploaded, and then it'll get through to Xero, the accounting platform. And this is the best way to record all your expenses. So even if a bill comes in for WAPs, you see the invoice, you pay it, you forward the invoice into HubDoc. So you get an email address, the app on your phone where you can take photos, and there's also upload documents. If you've got old bills, you can just drag and drop them in from here. So it's very easy and convenient. It's just like an email or a photo, and then we will process this into Xero. So I don't know if any of you have had a look at Xero, but this is one of our training groups, so we don't have to worry about Poppy or anything. So the dashboard, it gives you your bank accounts down the left here, and each bank transaction will come through. They either pull through live or you pull them through once a month of a PDF CSV. Okay, these are the training groups, so they're not 100% set up. So then we will reconcile that slips from HubDoc into the this is our training is going well. I haven't got any unreconciled transactions that I could show you. But yeah, so you get your bank statement here on the left, and on this dashboard is any bills you need to pay. So all those expenses you push through HubDoc, at one glance or sitting here. So hold on, this month I owe out 800,000 or 400,000. We will obviously recon what we can and sit with you guys each month with a query list to reconcile that. All your expenses are recorded, your VAT's claimed if that's applicable. And the same thing with your invoices. The minute you make an invoice, you need to make it in Xero. It's the one of the best systems. If there are, I saw in the comments, there are other billing systems, and 99% of them integrate with Xero. So if you are using a billing tool, we integrate it into Xero, and all your invoices will come in here awaiting payment, waiting for the money to come in the bank over here, and we will again match what we can. Invoices that aren't paid. It's just a quick 2 clicks, and you can see how many months, like this 50 rands from Edward's been outstanding for 3 months. So you can look quickly and know where to follow up. Like that 600 has been 2. These balls are all older. They'll need addressing, but this is just in a nutshell what you can expect from Xero, because I could just sense that you weren't 100% clear on the thing. And if you just need to make a invoice, you obviously preload your customers. You can open job files for them. You can go here and you can type or create a contact. If Mr. Kukumo is sitting in front of you, you can just record his details. Or if you're invoicing for a second time, then you've preloaded your items, which we'll all assist with. And it's just 2 clicks. So there's your customer. It's a standard invoice. You can adjust the price. If Mr. Kukumo's toe is sore, but not his big toe, and you only want to charge him 1.5, I mean, it's as easy as that. You can adjust it and approve an email, and you can email directly to them from Xero. We obviously will have a deeper training session, but I thought I'll just let you guys know how quick and easy it is to use Xero. Thank you.
Cool. Thanks, Ken. Yeah, so guys, a lot of this stuff would be a seamless process in terms of, and I think unfortunately with us joining the team a bit later, you guys haven't had the introduction where this is going, but it's a seamless integration in terms of register your business. That information gets utilized to register your accounting platform, HubDocs, and everything's got all your legislative info because you need it on your invoicing. And that then flows through in your HubDocs. So when you're incurring expenses, those things already come through. We set up your chart of accounts. You have a specialized chart of accounts that's already making it easier to understand your books, your inventory being inventory actual product that you might need to utilize, as well as inventory in terms of services that you're going to bill for. Those get brought in, and then it obviously all exports through into the analytics platform Snapshot, where you can at a glance see where your business is. Snapshot will track when things are due and things like that. So, and then with this data, every Monday we send out a mail to our clients going, we still request the following information. There's invoices in HubDoc. How were they paid? Because we haven't seen it go off the bank. You might have paid it personally. So you get this continuous reminder. This is what's due. This is what's coming up. These are the regulatory frameworks to be thinking about. And this continues. And then we've got to talk like this, because the thing we call the year in the life of a company, there's things that happen at different times of the year, which are important for you to be aware of. And it helps just with your planning. A lot of it's just also Entrepreneurship is a lonely business. Maybe you just need to hear, oh crap, I'm not the only one who's going through this. And then to help you sort of adjust and, know that you can reach out. Drop a mail, middle of the night, you get back and you got a question, drop a mail. We can respond to it and things like that. So that's kind of what it is. It's a general hand holding. So I'm going to circle right back to the beginning when I said to you guys, 9 out of 10 businesses fail within the first year. 9 out of 10. The only businesses we have that fail in their first year are the entrepreneurs who are unable to gather those 3 questions. Who do you owe money? Who owes you money? And how much is in the bank? If you can't get that information to a bookkeeper or on a spreadsheet to keep track of it, those people fail. Every one of our other clients who run through what we're doing and answer the questions and look at their management accounts when we set up a meeting, they are all in business. To give you a real example, when COVID hit, we didn't lose a single client, not one in COVID. In fact, our business tripled during COVID because we could do what we're talking to you guys about. We flow through all these things, we check all the stuff, we give advice when it's required, we understand the tax planning. So you're on the front foot all the time. And that makes a massive difference. That's what separates the people who are successful still after 1 year and those that don't. Cool. Guys, there's a lot of information you've just gone through here. And you're going to have 1,000 questions after we end this session. I don't know if Ed's going to share it or if Danica will share the recording. We normally, when we do these talks, we share the recording to all the participants. We normally post it on our YouTube channel, but this is more personalized to yourselves, so we can obviously manage how that process gets to you. I would advise take a notepad, whether it's electronic or and just jot all the stuff down that's in your head now. Listen to the video again, the talk again. Refine those questions because you're going to add to it, I promise you. And then drop us a mail. Because you're going to have questions, I promise you. You're going to have questions. And we're already seeing things like things to integrate. Xero are a bunch of really good tech accountants. We've known them since they've came to South Africa. We've worked with them. We've broken Xero more than once. So a lot of the integrations, a lot of the things you might be thinking about, we can actually help with your integration. We can talk to the owner and say, hey, this is a demand, and they can develop it, things like that. So yeah, just thank you for your time. Hopefully you guys have come away with a lot of stuff. Apologies if you don't go sleep immediately because you've got a lot of things to think about now and realize, oh crap, there's more regulations than I thought possible. But you've got someone to talk to now and ask. Last question, Celine, should we wait to start our business bank account until our business is registered? How would I say this? It's not necessary. But what's going to happen is when your business is registered, you're going to have to open an account in the business name anyway. So if you're billing now, you're billing as a sole prop, or you're getting paid as a sole prop. Rather let that keep flowing into your sole prop. And when your business comes in, there's a whole lot of really cool technical tax things we can show how to bring all these things into your business where you get a loan account in your business. And there's a whole lot of stuff that we can't cover in detail because it's going to be specific to each of you. And you're going to be sitting there going, holy crap, there's even more information we didn't know. But how we bring these things in, what it does for your business, where your assets get accounted for, and it's going to be specific to each of you, where your journey is, where your locum money goes, where you want to bring it in. Maybe you're already being taxed on locum because 80% of your money is coming from a single source. How does that change? How do we stop them from taking pay-as-you-earn off? Lots of good stuff where all that ties into. Okay. So we're more than just debits and credits. If you've got a business question, that's what we're here for. That's what we're entrepreneurs before we are and accountants. Make use of that. Okay. Thanks, guys. We really appreciate that. And yeah, we'll hopefully be hearing from most of you. And yeah, we go forward from there. Thank you very much. Enjoy the rest of your evening.
Thank you very much. Have a good evening as well.
Thanks, everyone.